Record. Good afternoon, everyone. My name is Marissa, and I will be your host and administrator today. Welcome to the Abernathy Group Family Office January 2025 First Friday meeting. Today's presentation is titled The All-Weather Portfolio for 2025. In our First Friday meeting today, we will discuss the opportunities and risks of investing in an overvalued market. We are going to discuss tactics that will allow intelligent investors to remain invested while lessening investment risks for those who want to make sure they don't have to go back to work and make it all over again. 2025 promises to be a challenging year as most public markets are priced for perfection and speculation is abundant. Our goal today is to make sure your portfolio allocation considers the risks inherent in an overvalued market and your return expectations are reasonable based on the challenges which confront us as we enter 2025. Today, our prepared comments will be recorded as other families who are unable to attend have asked for the recording. Our comments today will be approximately 20 minutes long, leaving us plenty of time to take questions from everyone on the call today. If questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box at the bottom of your screen, or write it down and raise your hand at the end of the prepared remarks by clicking on the react icon at the bottom of the screen. I want to remind you that we really enjoy your questions and we will do our best to get to your questions at the end of our prepared comments. One final note, please remember to mute your device's microphone and stay on mute unless you have a question, as background noise is audible and is distracting. With that said, let me turn the presentation over to Matthew Daly and Stephen Abernathy, who will provide today's commentary.
Welcome, everybody. I'm Stephen Abernathy, and this is the January 2025 First Friday meeting for the Abernathy Group family office members. Just a short note that this is our 26th monthly First Friday meeting, and all of the meetings recordings are available on our YouTube channel and our website if you'd like to go back and take a look at what we've said and how it's turned out. And as I mentioned last time, for each of you that haven't been to our website lately, please, consider stopping by if you have any questions. There really is a wealth of information and some clever estate planning ideas that each of you might consider. We believe, as many sort of responsible business owners believe, that the U.S. is likely to allow all of us fewer, the ability to pass along fewer assets to our beneficiaries in the future. And as I said last time, as I bring this up, because for many of us on this call, the exorbitant taxes that estate taxes incur on our hard-earned money that we've saved pretty diligently over our lifetimes, it's a pretty bitter pill to swallow, and we want to ensure each family is entirely able to pass along as much of their wealth as they desire to their chosen beneficiaries. And as a last shameless plug, we recently started a new company focused on reducing the costs of offering employees a corporate 401k plan. While the important part is, while offering each employee the education they need to make intelligent decisions about their future. So in short, and to get off of this topic, our goal is to turn the staid and boring 401k plan from a cost center into a benefit that will allow business owners to increase employee retention during difficult hiring periods and to help recruit valuable new employees. In short, if you have a few minutes, and if you have a retirement plan, give me a call or stop by the website. There's lots of research papers that and press releases that we've made over the course of the last 6 or 8 months, and you might find it interesting. As Marissa said, this month we want to start investing. We want to discuss investing in an overvalued market. The point of this is that it's a tricky proposition because overvaluation typically comes along with euphoria and the fear of missing out, or FOMO. The investment challenge in an overvalued market is that the risks are higher than normal and the rewards are much lower than normal. Although because of the euphoria and the FOMO, it doesn't seem as if the risks are higher than normal, and it certainly doesn't seem that the rewards are truly diminished. People just ignore it. They just go with the flow, and they think because nothing bad has happened so far, it means that nothing will happen in the future. And that's the wrong way to look at things. In some cases, the rewards available are more likely than not to offer actually negative returns, as you'll see in some of the data that we have for you today. So we're going to discuss the investment landscape, beginning with current valuations first. I think that's the first step. What's priced into current valuations? What do these prices tell us about what investors should expect in returns over the next 5 to 10 years? And we'll then spend some time discussing the economic backdrop supporting our stock and bond market. So today's investors are confronted with a new administration entering Washington with a considerably different playbook. Let's see if we can get this right here. The new administration is going to have to fix a shattered immigration system, a failed educational system, a bloated government, and a geopolitical environment teetering on a knife's edge of becoming a global conflict. And they're going to have to solve all of these problems with an inherited $2 trillion deficit planned for 2025. And if that task seems insurmountable, the new administration is going to have to tackle these challenges while paying an ever-increasing interest rate on $35 trillion of U.S. debt aggregated over the last 25 years by each of the administrations in power since the early 2000s. And, this continuous overspending, more than we save, is ridiculous. Next, we're going to discuss the geopolitical arena that we envision, or that we enter 2025 with, because this is, as we mentioned last time, one of the one variable that could change each of our lives forever. And we're going to end our discussion today with some thoughts about an all-weather portfolio. We'll discuss some of the tactical themes which may be helpful to some investors on the call. We'll discuss the questions each investor should ask before they make any investment decisions. And we'll end with an idea or two that we believe offers a really high probability of becoming true, combined with a valuation which is welcoming, thus offering both current income if we're wrong and appreciation if we're right. With that said, let me turn it over to Matt to introduce our first topic.
Thank you, Stephen. As you said, we'll start with valuations. So the S&P 500 last check is trading a smidge under 25 times expected earnings, which is well above the average of 15.8. And while valuations are high, they're still below the peak that was seen during the dot-com bubble. But like the dot-com bubble, these valuations are also heavily concentrated in growth sectors. And the elevated valuations mean there's less room for error or disappointment. And analyst Matt Rowe from Nomura Capital said that they're priced for perfection, and any deviation could result in significant negative impacts. That said, let's start by understanding what investors are pricing in when investing in the stock market at today's valuations. Are investors being offered investment prices which provide some meaningful upside, or are prices fully valued and potentially counting on a future that is near perfection going forward?
So thanks, Matt. As always, before we begin to allocate capital, it's a very good idea to understand the investment environment in which we're entering. Environment welcoming, as we said earlier, and is there a good reason for the investment buyer to offer inexpensive prices? So if it's welcoming and prices are low, are the reasons for these investments to be low realistic? Are the reasons temporary or longer lasting? And finally, what does the current valuation backdrop compare, or how does it compare against historical valuations? Keep in mind, this comparison is not to be used as a timing mechanism. It's to be used as a barometer of average returns. As history clearly indicates that when investors pay more than they should for investments, future returns are lower than average. And when investors pay less than historical averages, they tend to reap higher returns. This slide shows us that the current pricing is at the higher end of what's typical. The solid blue line indicates the average valuation, and the dotted lines indicate one standard deviation above the average. So currently, we're at levels where investors should be expected to return significantly less than the market's average return over the last 100+ years. So, what's the market expecting? In the last First Friday meeting, we highlighted the fact that Wall Street tends to suffer from the incentive dictates behavior phenomenon, meaning they tend to be overly optimistic. In fact, as slide 5 shows, over the last 25+ years, current valuation levels have indicated downturns are to be predicted, as current expectations have most often disappointed investors. We're back at those levels again. As we know, a combination of earnings and emotion determine the valuation of every asset. In our current environment, it's clear that fear of missing out, or FOMO, is abundant. As we discussed in last month's First Friday meeting, speculation is it's everywhere. From digital currencies to artificial intelligence to leverage. However, what tends to overwhelm FOMO are the actual data, or the earnings that take place. So let's take a look at the earnings expectations and what they tell us about Wall Street's current expectations. As we said earlier, this slide confirms Wall Street's tendency to overestimate the future. As you will see, as the periods in the past are shown relative to the periods in the current, meaning December 27th, 2024, you're going to see earnings continuously redone lower, or re-estimated lower. Here you can see, as recently as the last 6 months, Wall Street estimated 2025 earnings to grow at over 14%, and as recently as December 2024, they decreased their estimates to just over 12%. Our estimate is that this will continue to shrink as the data come in during 2025. However, it's always a good idea to take a look at what historical outcomes offer as a way to ensure our feet are well anchored and our expectations are well grounded. The next chart is going to show us what historical outcomes take place when pricing is mixed with a range of rosy outcomes all the way down to dire outcomes. This slide is the one we shared with you on the last First Friday webinar, and we thought it's important enough to bring back for this month's First Friday meeting. And it's from our friend at Crestmont Research. He's a brilliant guy, and he doesn't suffer from incentive dictates behavior. He just looks at the data. Here's how you should read this slide, and just follow along with me for a second. On the right-hand side, you'll see the pricing multiple of 22.5 times earnings. So this is only a slight bit under our current pricing. We're at about 23 or 23.5 times earnings. Incredibly overvalued, nonsensical, but it's been here for a while. What's the importance of this? What this says is if we stay within the current speculative pricing environment, which is unlikely, and earnings continue to grow at historical levels with no recession, that's also unlikely, you will see the expectations should be for returns over the next 5 years of negative 5%, over the next 7 years of negative 2%, and for those who can live through a period of 10 years or more of negative returns, they might be able to achieve a fraction of a percentage point return over a 10-year period. Of course, if the market returns to its normal price earnings expectations of 15 times earnings, investors are likely to have losses over the next 5 years, 7 years, 10 years, only to start receiving returns of 2% or so over a 20-year holding period. That's a lot to ask for dedicated investors, even, as I should say, even the most dedicated of investors. And for those of you who believe the world is overpriced and understand that during most periods of history, overvaluations lead to undervaluations, and most bull markets lead to bear markets. Just as markets get overvalued based on overly optimistic future expectations, bear markets usher in dark and dismal expectations, often far darker than history tells you to expect. But it happens. And just as things get overvalued, they get really undervalued. In short, as you can see, the math tells us to expect terrible returns if expectations turn decidedly negative, and which is not our base case. We're not projecting that markets move to 10 times earnings. However, if it does, I want people's expectations to understand that difficult periods are ahead. Let me stop right now, right here, and see if there are any questions or comments before we move forward, because this is an impactful slide, and I want to make sure that everybody understands it. Is there, Marissa, are there any questions or comments so far?
No questions sent in so far, no.
Great. Okay. For each of you that are out there, if you have questions or if you have comments, please don't hesitate. This is really scheduled to be a forum, where we have dialogue. It's fine. Matt, let's move on to the next topic.
Sure. Let's touch on 3 other topics related to the U.S. economy. First off, I think a lot of people have the transition of presidential power on their minds and what the new administration may mean for the economy, like you mentioned. A few of the major changes that have been mentioned, just a few, are extending the 2017 Tax Cuts and Jobs Act, imposing 25% tariffs on all goods from Mexico and Canada, as well as 10% on all Chinese goods, and maybe even 10 to 20% universal tariff. General deregulation, a renewed focus on domestic energy production, and the brand new Department of Government Efficiency, along with some of the other things you mentioned earlier. Most of the forecasts I've seen have shown an increase in the budget deficit, additional to what's already on the books. And so, can you pick on a couple of the proposals or themes of this new administration and how we might be able to frame them or look at them through the economic lens and what they might do with the U.S. economy in the next year and 4 years?
Yeah, that's exactly right. That's the right way to look at this. As we mentioned earlier in the presentation, the new administration faces significant hurdles in achieving what the citizenry of the United States hired them to do. This is, it seems to be almost a daunting task, but, and, you know, with change comes pain from time to time. So I don't want to rule that out. I want to make sure we remind everyone that it's a different, you know, they enter this period, and almost every administration enters the White House with a difficult period ahead of them. This is not, it's not, just not unique. The commentary, promises, and the emotion evident on the campaign trail seldomly translate into direct activity once the victor inherits the White House. You know, this is true for both parties, and it's not intended to be a political statement of any kind. With that said, the cabinet is being proposed, or as being proposed by the new administration, has to be agreed on, largely has to be agreed on by Congress, or for the most part. The promises for tariffs across the board have a higher probability of being made good on, yet most political analysts will tell you that it's far more likely that the tariff rhetoric was more, or was a negotiating tool more than a surety. And I think that almost every political analyst, at least the ones that we follow, they will tell you that the tariff talk will most likely lead to a tactical use, and if used intelligently, may work out to be generally positive, although it may usher in another bout of inflation. So I would keep my eyes on the inflationary aspects of the tactical tariffs that are instituted, and cross your fingers that the United States Federal Reserve is in lockstep with that, with what's taking place. The most tenuous of all considerations, in our opinion, comes from the history surrounding the current administration's ability to listen to its advisors. And again, I'm not making a political statement. I'm just looking at history. The current administration tends not to listen to its advisors, and it has difficulty sharing the limelight with others. I don't think this is anything new to anybody on the call. History tells us that the prior administration, for the currently elected official, meaning the advisory board, which was erected to share ideas with the administration, and listen, it was comprised of some pretty high-level CEOs across the United States. It was really an impressive list of intelligent and experience. And we all know that this, you know, that didn't work out as well, as the advisory board ended disbanding itself, and it was disbanded for any number of reasons. Our hope is that the lessons were learned, and that the current administration and the current advisors will stay the course. There are some terrific advisors on this sort of advisory board, or surrounding the current administration. We believe that they have the ability to offer intelligent insights and advice, and I think that they are capable of offering, and most importantly, offering the administration incredibly valuable, forward-looking ideas. And we hope that the administration will listen and largely follow the expert advice offered. I know that that's maybe not what people were thinking about talking about today. So Matt, do you have any thoughts that might conflict with that, or just tell me what you think about how that might turn out, if anything?
No, I think you gave a good summary. I think there's certain aspects that are rollovers from first Trump administration. I don't foresee any hiccups with extending the tax cuts, although anything's possible. I think, it'll go back to kind of a tighter immigration. But there are a lot of new things like the Department of Government Efficiency. There's a lot of new faces, like you mentioned. So I think there are still a lot of unknowns. And, of course, we don't know how the confirmations will go. And I think definitely we don't want to be overly optimistic. It's very hard to get these things through, no matter what the policies are, no matter who's entering office. It's never as easy as they think. They can say a million things on the campaign trail, and they can truly want to get them done, even. But, Washington ultimately works the way it works, and you never know. But yeah, I think having a good group of new, fresh faces in there is going to be interesting to see. And if he listens to the advisors, then perhaps some good things may happen.
Fingers are crossed. Fingers are crossed. What's next?
All right, so let's jump on to the next topic. We mentioned the potential for steadily high or even accelerating inflation due to some of the policy proposals. We had some rate cuts in the latter part of 2024. What might we expect the Federal Reserve to do going forward? Is it kind of wait and see because of all these uncertainties? We'll see what happens. Or does action need to be taken on the recent uptick in inflation, the last 3 months, I think, or so, regarding rates?
Well, okay, so here's a slide, and as you can see from the dotted lines, the dotted lines represent the market's prediction of where rates will be, and the solid line represents where interest rates actually were. The importance of this chart is twofold. First, we should not assume that anyone can predict where interest rates will be over the next year or more. This means that every investor, no matter how intelligent, should be diversifying their holdings in all interest-bearing securities. Keep in mind that the tried and true philosophy, the more you know, the less you diversify, the less you know, the more you should diversify. And this chart just speaks volumes to the most intelligent people on the planet, and most often the most intelligent entity on the planet, which is the market, just has a lot of trouble getting it right. Second, the takeaway is that, as you can largely see, and this goes for what we're going to talk about later in this webinar, the last 15 years have largely been years where interest rates were at or near the 0% boundary. When you have investors committing money at 0% or near 0% interest rates, speculative activity runs rampant. We have yet to witness the fallout from the 15-year period. And I know that I sound like a broken record because I've been saying this for the better part of a year and a half now. This last 15-year period was unlike any other period in history. And I'm a little surprised that we haven't seen some fallout from the speculative activity so far. We're going to see, as the future unfolds, if the speculative activity which took place during the period of the last 15 years has the ability to shape our future in a less than positive way. Matt, the next topic we have as it discusses sort of the amount of liquidity in our system, because liquidity truly influences the stock and bond market. More liquidity leads to a strong investment backdrop, and less liquidity tends to lead to a weak investment backdrop, and equally often a recession. Any ideas?
Yeah, is liquidity an issue, and is that a major issue in the markets now, or something investors should be wary of going forward? What do you think?
Well, from our standpoint, liquidity remains abundant, although over the last 12 months, the U.S. Federal Reserve has been continuing to reduce its balance sheet. Now, most of the people on the call aren't going to be aware of what's happened. Over the course of the last 12 months, silently and in the background, the U.S. Federal Reserve has reduced its balance sheet from well over 6 trillion to a bit just over 3 trillion. And that's happened during the last year. And as I mentioned just a moment ago, when the U.S. Federal Reserve reduces liquidity, it typically leads to uncomfortable outcomes. So this is silently going on in the background. He told us it was going to happen, but we need to keep our ears tuned and watch the 10-year U.S. Treasury bond. As you can see from this slide, and we've used it in previous First Friday presentations, the U.S. Federal Reserve and the administrations in power have increased our liquidity over the past 50 years by levels that would embarrass most business owners. As this slide shows, over the last 15 years, we've become even more profligate in our spending by doubling our overspending and doubling the amount of debt the U.S. owes the rest of the world. You know, as we've said in almost every First Friday meeting so far, and to each of you privately, this bout of overspending, it will not end well. It's unsustainable. It must stop. When it does, it will be painful to a citizenry which has been accustomed to low rates and abundant amounts of money available every single time our country gets into the slightest bit of trouble. So again, I don't want to harp on a negative topic, but this topic really, it's sort of in that geopolitical topic variable area. It worries us, and it could change the way our life moves forward. With that said, let me turn it over to Matt for some thoughts on the geopolitical environment and some ideas on how to deal with a set of unknowns that have a low probability of taking place, yet a significant impact if they do take place.
Thank you. Yes, I didn't want to cause alarm, but based on my readings recently, I definitely do have a little bit of a shift in mind. I believe that it's pretty likely the next 5 to 10 years will be defined by global conflict. I think Ukraine, Russia, and Israel, Hamas, Hezbollah, it's just the beginning of a much broader period of turmoil that will extend much further. Sort of like the little tremors you feel before the big earthquake. Africa and the Middle East are both tinderboxes at the moment, with potential conflicts virtually anywhere you look and everywhere. The conflict in the Palestinian state has been a major call to action for terrorists across the globe, and October 7th has inspired them to rise up and believe that they can have a real geopolitical impact. From Central Africa across the north, through the Middle East to the Caucasus Mountains and the stands of Central Asia, thousands of people are currently joining various terrorist groups to the point where they can't train them fast enough. Intelligence operatives, former intelligence operatives have reported that 10,000 trained Al-Qaeda fighters have been deployed to Syria, as well as 1,000 trained terrorists to Europe and 1,000 to the United States already. Afghanistan and Syria are two large countries entirely controlled by terrorist organizations. Lithium mines in southern Afghanistan are occupied by Al-Qaeda, the Islamic Revolutionary Guard of Iran, and Chinese officials all under the same roof, which is an alarming development that suggests China will use potentially terrorist proxies to their benefit to disrupt the West and especially the United States. The world being on fire benefits Chinese plans to reintegrate Taiwan in the next couple of years. Overall, all of this suggests that not only will conflict involve the globe, but it will likely be coming to our backyard by way of thoughtfully planned and highly coordinated attacks on our soil by a variety of means. While historical data shows us that terrorist attacks create volatility and market downturns, the drop in equity prices tends to be temporary or short term, and markets recover. However, it can be assumed with relative confidence that increased or major terror attacks on the US and European soil will mean a return of significant US troop presence in Africa and the Middle East. Terror attacks will largely affect travel, tourism, and consumer optimism, especially in Western cities, and people will be less willing to go to large events. The result of widespread conflict will be unifying and dividing. As we have mentioned many times previously, in the past couple of months on the first Friday, the world will be divided into factions of nations, and we will be driven further away diplomatically and economically from our perceived and real enemies, and we will be driven closer to our allies. Trade flows will likely be disrupted in a scenario like this. However, the hardest thing to deal with will be the new age warfare of cyber and infrastructure attacks. We can prepare for this in a variety of ways. You know, it's like any turmoil or tumultuous event. General uncertainties, asset class diversification, sector diversification, and geographical diversification are all strategies to consider. Embracing safe haven assets like gold, defensive stocks, treasury bonds, and cash for a portion of your portfolio could be protective wealth preservation measures. At this point, I believe it's probably critical to consider geopolitical risk when allocating investments. If you have international investments, considering geopolitical hedging strategies like put options or collars to limit downside risk and currency hedging could be ideas. It would be wise to deeply analyze your commodity exposure, not only in the direct investments you may have, but also by taking a look at the commodity exposures of the equities you may be invested in. How exposed are those companies to commodity risk from potential unfriendly countries? Rebalancing and regular portfolio reviews always are prudent given the level of global uncertainty. I'll get off my soapbox here by stating that there's no need to panic. These are just things that may happen, and it certainly looks like it is going in that direction. Actually, on the contrary, investors should buckle up and be patient. Kind of the ethos and well-practiced mantra is to prepare for the long run and maintain a wealth preservation strategy that weathers the storm. Like I said, even major terrorist attacks, conflicts, they tend, even if they affect the market, certainly the bifurcation of global interest is, could be a longer term thing, but adverse events, conflicts, terrorist attacks, those things tend to affect the market, increase volatility, but then the market bounces back, in relatively short amount of time. And if investors prepare adequately and make wise collected decisions, there's an opportunity not just to get through the uncertainty, but potentially grow your assets, amidst it. Did I cover that okay? You have anything to add?
No, I think it's well said, Matt. That it's a lot to chew, and with all of these things, everything is so uncertain. We don't know what other people are thinking. We don't know what other people. We don't know what other countries are thinking. We don't know what's going on inside of the turmoil inside those countries. We don't know exactly what their game plan is, and I worry, always worry about these life-changing events that are very small, that have a very small probability of happening, but a very large impact on your lifestyle. And it's hard to get investors to acknowledge the fact that these kinds of things can happen, and because they don't happen very often. And so what we're sure of is that that, as you said, the world is bifurcating. Mercantilism, or the production of goods and services at home or with friendly partners, is going to take place. And that's some of the ideas that we have for you on the next portion of this discussion. Let's discuss the all-weather portfolio. What we're trying to describe here is an investment stance or an investment allocation that will both allow us to continue to grow assets at reasonable levels while sleeping well at night. Keep in mind, there's no such thing as a perfect investment. And again, I'm not trying to be a hedged person. I'm just trying to make sure that we're putting things in the right context. As I said, there's no such thing as a perfect investment strategy. Markets go up, markets go down, and markets stay flat for extended periods. And most people don't really realize this because they haven't because they have lives and they haven't spent the time looking at what happens over extended periods of the marketplace. But I will tell you that having the right expectations associated with the appropriate timelines is crucial when making intelligent decisions, whether and even whether it makes sense to be invested or not, or just be into treasury bills or in real estate. Sometimes investing in the market is not the right choice, and that's okay. Sometimes it may make more sense to pick an investment or a product that has less growth potential and less downside risk than being in the market. And it's just tough seeing your next door neighbor exhibiting gains every day and talking about it over dinner when you're hunkered down for the long term. The one thing that I think is universal, and Buffett would support this, don't let fear of missing out or FOMO on potential growth lead you down the wrong path of making bad investment decisions. When things are overvalued, they're overvalued. Don't go there. Here's the message for the next topic. We're not trying to be glass half empty market strategists. However, we do want to deal with current data and market history. And here's the point. Overvalued markets do not have to end in a tumultuous downturn. As often as not, the overvaluation continues for over a decade with little or no appreciation. In this next chart, we're going to see a listing of the periods in which expectations for future gains in the stock market became so euphoric or extended, the US stock market became overvalued to a level, and in each instance, it took more than 10 years to recover. Now, just understand that. It's easy to say this and to talk about it now, but believe me, when you're in a marketplace and you have an investment that hasn't done anything for 10 years except go up and down and give you agita every day, it's a difficult road to hoe. This means investors in the stock market, as I said, had to wait more than 10 years through a significant amount of volatility before they had a positive return. In 1906 to 1924, the market went nowhere while we went through a world war and a pandemic. Disastrous. From 1929 to 1952, that's 25 years now. The US stock market, again, went nowhere. We entered, we rebounded from a world war and rebounded from the worst depression the US has ever experienced. But investors in 1929 had to wait until 1952 to start appreciating. From 1966 to 1978, another 13-year period where the stock market went nowhere while Volcker, the US Federal Reserve Chief Paul Volcker, fought the most vicious inflationary bout in recent history. And from 2000 to 2012, many of you will remember this, the stock market registered near 0% returns with volatility that saw the NASDAQ plummet more than 75% over that 12-year period. The point of these slides and this topic is to remind everyone that we're not yet able to predict the future of the market. No one can. Yet we are able to see what history has offered when markets tend to be overvalued. And it means that future returns are going to be lower than expected. I'm just telling you, it is a virtual certainty. It could come from a severe downturn, or it could, become a decade of no returns. We're trying to avoid both with this discussion. For those of you who would rather see the amount of pain and volatility overvaluation can create without going through a significant crash, take a quick look at this chart, which clearly documents each of the periods in which the stock market became overvalued to the point that it took over 10 years to recover. Believe me, this is important. This slide highlights each of those periods and shows you, more importantly, where we are today. The red oblong or obelisk in the upper right-hand corner shows you where we are today in terms of valuation. So where does it leave us? Here are some ideas for everyone. Stick with quality investments. I know that sounds like the most redundant thing in the world to most of you, but it's the truth, and it's valuable. You can define them as investments that pay dividends. If you think a company is high quality and it doesn't pay a dividend, I would ask you why. It's sort of equivalent to owning real estate and not charging rent. Why are you doing that? It doesn't mean that it's a bad investment. It just means that it's a head scratcher to me. Having income, as Warren Buffett would tell you, again, you don't have to listen to me, but you should listen to Buffett. Owning assets without income is seldomly intelligent. If you're going to invest in the stock market, stick with investments that are paying dividends. Think of them similarly as your real estate over very difficult periods of time. If we had a chart of real estate market over this period of time, it would look very different than the stock market. Think of high quality companies that pay dividends and understand that they increase these dividends every year. This is the mark of some high quality companies, and it may seem overly staid and boring, but it's very valuable over difficult periods. Think of the investments that will survive a political downturn. So in our opinion, Tesla is a poster child for a company that's at risk. They've got a ton of assets outside of the United States and a ton of assets in one of our biggest potential combatants in China. Conversely, there are many companies like AT&T or Verizon. They pay 5 and 6% dividends, and almost all of their assets are within the United States borders. Here's some questions to ask yourself about the investments that you have. And again, I'm doing this because every family is different and every family has its own internal goals and sort of the way risk tolerances, I guess, is the way we'd say it. Here's some questions to ask yourself, and you should ask yourself about this on every single investment. What is my base case outlook for the next 12 to 24 months? So for each of the investments that you have, you should be able to answer that question for each of these investments. Make sure your investments measure up to your expectations in terms of A, what you're paying for the investment, and B, what your expectations are for a reasonable future moving forward. Shortly after answering that question, ask yourself the following question. For each investment, what happens if I'm wrong? If I'm wrong, do the dividends or the income I'm receiving for the investment allow me to continue with my lifestyle? If the answer is no, reassess. If the answer is yes, you're probably in a better place than not. Let me spend this. I know that we're going over time, and I'm trying to hustle through this. And if you'd like to talk about this more, we can talk about it until the cows come home. But here's a couple of ideas that are really high probability of taking place, combined with the fact that they're not overpriced, and they may surprise you a little bit. First, energy seems to be at the top of our list. Energy during geopolitical conflict becomes currency. If you'll look back at the reasons that anybody lost any major war, energy and finances are sort of at the top of that pyramid. Keep it in mind, energy really is at the top of our list. And as I said, if we break into a geopolitical conflagration, energy will become incredibly valuable. If we avoid this unfortunate future, the demand for energy is predicted to double in the next 20 years. Nuclear won't be around in time. Renewable resources can't do it. Natural gas seems to be the least polluting, most abundant source of energy that our country has. And the bottom line is, we're the world's leader in it. Don't ask me why we haven't been harnessing this for the last 20 years. But again, just as an example, one idea that you should have on your purchase list or your investment list is natural gas. Longer term, nuclear, the small modular reactors are probably going to become very valuable, and renewables seem to be well positioned to also benefit if we can get the costs down. Either way, energy is a central theme. Let me stop there because, again, we can go on and on forever, but let me stop there. Marissa, any questions that have come in so far?
No questions, Stephen. Thank you.
Okay. Okay, let's take this opportunity to sort of end our discussion. And before we go, we want to take a minute and thank Marissa for sticking with us over the course of the last couple of years and moderating our events. She's going to be entering a position that requires her to travel extensively, and she's let me know that she doesn't know whether she's going to be available on our crazy First Friday meetings. So we want to, I can't, we're going to miss her. And if anybody has a good idea for anybody that could follow up and it could be our moderator, please let us know. In the meanwhile, God bless everyone. Thank you for attending. Any further comments, Matt, for us in closing?
No. Happy New Year to everybody.
Happy New Year to everyone. We hope 2025 supports all of you with good health and safety. God bless.